Joining us now is Quincy Krosby, Chief Global Strategist for LPL Financial. Quincy, it's like one of those 80s horror movies, right? Inflation, where every time you think they're dead, they come back. And all of a sudden we get this stronger than expected inflation number, more Fed Bullard, this, that, more rate hikes. Where and how, maybe like a horror movie, does this end?
Well, not only did Mester and Bullard talk about rate hikes, more of them, it was the 50 basis points part of it that got the market. That, if you take a look at the market, as soon as those 50 basis points came out of their mouths, all of a sudden the futures market priced in a little bit more for March 22nd, 23rd in terms of a 50 basis point rate hike. Not much, but it's moving higher. And having those two, granted, they are, on the hawkish side of it, they're not voting, but they are considered to be very keen observers for the market. So we've got financial conditions extremely easy. Just take a look at high yield. Take a look at the spreads. It's as if we're in Wonderland. The point I want to make is the market is beginning to grab onto it. And granted, we were going into overbought territory. Yesterday's market, we saw the small caps do very well, but you didn't see a whole lot of new highs. You would expect that after that kind of move. Those internals were telling us this market was prepared to just pull back, and we got the catalyst today. But it's more than just a day catalyst. It's something that changes the market's direction and perception.
I want to go back to that heady year 1995, Mike, because one of the top songs was TLC's Waterfalls, right? Don't go chasing water. I don't know how you chase a waterfall. They don't move. But that aside, I wonder if I bring up 95 in that song because 1994, the Fed raised rates by 2.5%, one of the most aggressive rate hiking cycles we had ever seen. All that happened in 1995 was the Dow rose 33%. In other words, history says just because you raise rates doesn't mean you cannot have a market rally, correct?
That's right. It's not really the level necessarily you've gotten to. What happened in 94, as you mentioned, the Fed was being proactive in trying to choke off inflation before it got to be a problem. It seemed to succeed in that. The stock market had a rough and choppy year, but not nearly as bad as 2022 was when the Fed was tightening last year. And really, that is the period where the immaculate soft landing that people like to point to as the best case scenario was executed, because in February of 95, Greenspan stopped raising rates. He even said maybe the next move is a cut. Market just didn't look back from there. It was a cheaper market. We were earlier in the economic cycle. Unemployment had more room to go down. But yeah, it is a good lesson that it's not necessarily the fact that the Fed has raised rates that says market can't perform.
I didn't set that up, Mike, but your words are perfect as always, Quincy, because there's two markets that we can look at. There is a market where one of these Fed heads, one of these days, uses the word cut, right, or lowering rates. We haven't heard that, and we may not. That would probably send the market soaring, is my guess. You tell me right or wrong. Or we have the market, which is what they're telling us, which is they're going to be higher for longer and don't even think about lower rates. Where do you stand?
Well, I say that, the Fed doesn't know any more than we know. And the Fed will be data-dependent. We're data-dependent, and so is the Fed funds futures market. So the key here really is whether or not the market can withstand even if rates have to go higher. I mean, for example, if they start talking about move from 5.5 terminal to, say, 6, the market's not going to be very pleased with that, because you don't mind higher rates as long as it is underpinned by growth. It's when those higher rates look as though they're going to, strangle growth that the market becomes very upset. So it's a fine line where we are right now. But again, we could end the year and just muddle through this and just have what we used to call very scientific, a muddle through in earnings, a muddle through in guidance, and a muddle through in the market, and get through this period. We need a bridge to when the Fed has reached that terminal point. And we're closer. There's no doubt about that. We're closer. Whether or not they do it with 50 basis points or a couple of more 25 basis points, we are much closer. The fact is, when you look at the numbers on the PPI, for example, it's moving in the right direction. Same thing with the CPI. We're going to have rents down, even though they're 40%. Rents are coming down. every industry report suggests rents are on their way down. It will show up probably in the next report, even at the margin, and then the one after that.
Maybe Quincy, maybe our viewers and listeners care more. They care about the Fed, but they probably care more about their investments. Do you think stocks can or will end the year higher than they are now?
Yeah, after today, yeah, I do. I absolutely do. And by the way, we're looking at fixed income. Fixed income is providing a tremendous opportunity for investors. I think people don't realize it because it's been so long since we've had such a rich offering within fixed income, whether it's investment grade, treasuries. And because financial conditions are so easy and loose, by the way, based on the Chicago Financial Conditions Report, take a look at high yield. I'm not endorsing that, but there's a reason those spreads are tight. They haven't sprung out. And therefore, the market is saying, look, there's a lot for you to do. You got to hang in there. We've got to get through this. And the question then becomes the love affair with technology stocks. Can they deal with higher rates, or have they just begun to normalize and not become those, standard long duration sectors?
I know.
This is important. Yeah.
Mike, I just wonder, and everything you read, people you talk to, I mean, a 4%, 5% Treasury yield, I mean, it's not great money, but it's risk-free, probably, and not awful. And if you get some tax breaks, if you buy directly from a state tax level, that's got to compete with equities at some point.
It certainly raises the hurdle for people's willingness to take on more risk in equities. The other purpose it can serve, though, is it can act as a pretty good buffer for taking risk in equities. In other words, if you're sitting there with a stock bond portfolio and you got 5% off the top in your fixed income, well, your first few percent in stocks on downside is covered in a sense. So it does actually return fixed income to that role of being support and ballast within a portfolio, even if you might not want to necessarily go out the risk curve as much into equities as you would when rates were near zero.
All right. Well, good debate. Tough day today. Overall, still a good year. Still a very good start to the year. And the January rule, if you want to call it that, implies good things for the year. We'll see. We'll meet back here in like 10 and a half months, guys. We'll see you then.